You just sold your stocks. The trade confirmation sits right there on your screen. $47,000 in profit. You did everything right. You picked the right companies, you held through the dips, you resisted selling when the market dropped 20%, and now, after 3 years of patience, you finally cashed out. Then your accountant calls. $11,750. That's what you owe in capital gains taxes. 25% of your profit, gone. Not to your retirement, not to your kids' college fund, not to that down payment you've been saving for. Gone. To the IRS. Because you sold on the wrong day, in the wrong account, using the wrong strategy. And here's the part that's going to make you sick. Your neighbor sold the exact same stocks for the exact same profit and paid zero, not $1, legally, because they understood something about the tax code that you didn't. And it's not complicated. It's not some offshore scheme. It's not even a gray area. It's written right there in the Internal Revenue Code. You just didn't know where to look. According to IRS data, Americans paid over $700 billion in capital gains taxes in the last fiscal year alone. $700 billion. That's more than the entire GDP of Switzerland. And the Congressional Budget Office projects that number is going to keep climbing because asset prices are rising, more Americans than ever are investing through apps like Robinhood and Fidelity, and very few of them understand the rules that determine how much of their gains they actually get to keep. Here's what makes this so frustrating. The tax code doesn't treat all gains equally. Two people can make the exact same investment, hold it for the exact same amount of time, earn the exact same profit, and pay wildly different amounts in taxes based entirely on how they structured the trade. One pays 25%, the other pays zero. Same money, same gain, different rules. And nobody teaches you this in school. Nobody explains it at your brokerage. Your HR department sure as hell doesn't mention it when they hand you a 401k enrollment form. My name is Phil, and I've spent the last several years breaking down the financial strategies that separate people who build wealth from people who just earn income and give a chunk of it back every April. I'm not a CPA, I'm not giving you personalized tax advice, but what I am going to show you are the legal, well-documented strategies that wealthy Americans use every single year to minimize, defer, and in some cases completely eliminate capital gains taxes on their investments. If you want to understand how the tax code actually works for investors, instead of just finding out how much you owe after it's too late, make sure to hit that subscribe button and give this video a thumbs up, because the 5 strategies I'm about to break down could save you tens of thousands of dollars over your investing lifetime. And by the end, you'll understand exactly which ones apply to your situation right now. Here's my thesis. Capital gains taxes are the single largest controllable cost in your investing life. Not fees, not commissions, not even bad stock picks, taxes. And unlike market returns, which you can't control, your tax bill is almost entirely within your power to manage. The problem is, most people don't manage it. They just pay whatever the IRS tells them because they never learned the 5 legal mechanisms built into the tax code specifically designed to reduce what you owe. Let's break them down one by one, starting with the strategy that works for almost everyone and ending with the one that could let you pass millions to your kids without the IRS touching a penny. Strategy number 1 is the simplest and most powerful. It's the holding period advantage. And it's something that most new investors completely ignore because nobody tells them how massive the difference is. When you sell an investment you've held for less than 1 year, the profit is taxed as ordinary income. That means it gets added to your salary, your freelance income, everything else you earned that year, and gets taxed at your marginal rate. If you're making $150,000 a year, that rate is 24%. If you're making $220,000, it's 32%. If you're above $570,000, you're paying 37% on your investment gains. That's the same rate you pay on your paycheck. But if you hold that same investment for 1 year and 1 day, the rate drops to the long-term capital gains rate. For most Americans, that's 15%. If your taxable income is below roughly $47,000 for an individual or $94,000 for a married couple filing jointly, the rate is 0. 0% on your investment profits, just because you waited 12 months. Let me show you what that looks like on a $50,000 gain. If you sell at 11 months, you might owe $16,000 in taxes at a 32% rate. If you wait 2 more months and sell at 13 months, you owe $7,500 at 15%. That's $8,500. Same investment, same profit, 2 months of patience. That's not a loophole. That's just knowing the rules. And here's where it compounds. If you invest that $8,500 in tax savings and it grows at 8% for 20 years, that one decision, waiting 2 extra months, becomes $39,000. One decision, $39,000. And people wonder why the wealthy keep getting wealthier. It's not magic, it's attention to details like this, repeated across every transaction for decades. Strategy number 2 is tax loss harvesting. And this is the one that separates investors who understand taxes from investors who just buy and pray. Here's how it works. Let's say you've got a portfolio with multiple positions. Some are up, some are down. That's normal. Every portfolio has winners and losers at any given time. Most people ignore the losers. They just sit there, red numbers on a screen, producing nothing but anxiety. But those losers are actually valuable because the IRS lets you use your investment losses to offset your investment gains. Say you made $40,000 selling some winners this year. Great, but you also have a position that's down $15,000. If you sell that losing position before December 31st, you can subtract that $15,000 loss from your $40,000 gain. Now you're only paying taxes on $25,000 instead of $40,000. At a 15% long-term rate, you just saved yourself $2,250 by selling something you were probably going to sell eventually anyway. But there's a catch, and this is critical. It's called the wash sale rule. If you sell a stock at a loss and buy back the same stock or a substantially identical security within 30 days before or after the sale, the IRS disallows the loss. It's like it never happened. The 30-day window applies both directions, so you can't sell on Monday and buy back on Tuesday. You have to wait. The workaround is simple. You sell the losing position and immediately buy something similar but not identical. You own a total stock market index fund and it's down, sell it. Buy an S&P 500 fund instead. They're similar but not substantially identical. You maintain your market exposure, you harvest the loss, the IRS is happy, your tax bill drops, and you didn't miss a single day of market returns. Some robo-advisors like Betterment and Wealthfront do this automatically. They monitor your portfolio daily and harvest losses whenever they appear. They claim this adds between 1% and 2% in annual after-tax returns over time. That might not sound like much, but over 30 years on $1 million portfolio, that's hundreds of thousands of dollars in additional wealth just from automated tax optimization. If you've made it this far, you're already ahead of 90% of investors who just accept their tax bill without questioning whether it could be lower. But don't stop now, because the next 3 strategies are the ones that the top 1% actually use to build generational wealth. And strategy number 4 is the one nobody talks about because it sounds too good to be legal. Trust me, it is. Let me show you. Strategy number 3 is what I call the 0% bracket harvest. And this one blows people's minds when they hear it for the first time, because most Americans don't even know this bracket exists. If your taxable income, not your total income, your taxable income after deductions falls below roughly $47,000 as an individual or $94,000 as a married couple filing jointly, your long-term capital gains rate is 0. You pay nothing. This means if you're in a year where your income is lower than usual, maybe you took a sabbatical, maybe you retired early, maybe you're between jobs, you can sell appreciated investments and pay absolutely nothing in capital gains taxes up to that threshold. Here's how smart retirees use this. A couple retires at 60 with $1 million portfolio. Their only income is Social Security, maybe $40,000 combined. Their taxable income after the standard deduction is well below the $94,000 threshold. Every year, they sell enough stocks to realize $50,000 in long-term gains. Tax rate? 0. They do this every year for a decade. $500,000 in gains, 0 in capital gains taxes. Meanwhile, their neighbor who waited until 70 to sell everything in one lump sum just triggered a massive tax bill because the entire gain was realized in a single year, pushing them into the 20% bracket. This is the power of timing your income. It's not about making more or less, it's about controlling when you realize gains to stay within the most favorable brackets. Financial planners call this tax bracket management, and it's one of the most underutilized strategies in personal finance. And this doesn't just apply to retirees. If you're a freelancer having a slow year, if you're on parental leave, if you took a pay cut to start a business, any year where your taxable income dips below that threshold is a year where you should seriously consider selling some winners tax-free. Those opportunities don't come often. Don't waste them. Strategy number 4 is using tax-advantaged accounts as capital gains shields. And this is the one that nobody talks about because it sounds too good to be legal. It's completely legal. It's been legal since 1997. A Roth IRA is the closest thing to a legal tax cheat code that exists in the United States. Here's how it works. You contribute after-tax money. That money grows inside the account, and when you withdraw it after age 59 and a half, every single dollar comes out tax-free. Not tax-deferred, tax-free. If you put $10,000 into a Roth at age 30 and it grows to $200,000 at age 60, that $190,000 in gains is never taxed. Not when it grows, not when you withdraw, not when you die and your kids inherit it. Never. Now compare that to what happens in a taxable brokerage account. Same $10,000, same $200,000 at age 60. You sell it, you owe 15 to 20% on the gains. That's $28,500 to $38,000 in taxes. The Roth saver keeps it all. The taxable brokerage account investor gives up nearly 40 grand. Same investment, same return, different account. $40,000 difference. And then there's the health savings account, the HSA. If you have a high deductible health plan, the HSA is the only account in the entire tax code that gives you a triple tax advantage. Your contributions are tax deductible, the growth is tax-free, and withdrawals for qualified medical expenses are tax-free. That's before, during, and after. No other account does that. And here's the trick most people don't know. You don't have to spend your HSA on medical bills this year. You can invest it, let it grow for decades, and use it for medical expenses in retirement, which is when you'll need it most. An average retired couple spends over $300,000 on healthcare. An HSA that's been compounding for 30 years could cover a significant portion of that, completely tax-free. The wealthy don't just use these accounts, they max them out every single year without exception. Roth IRA, $7,000 per year. 401k, $23,500. HSA, $4,300 for individuals, $8,550 for families. If you're not filling these buckets before investing in taxable accounts, you're voluntarily paying taxes you don't have to pay. Strategy number 5 is the one that makes tax professionals shake their heads because it's the most powerful wealth transfer tool in the entire tax code. It's called the stepped-up basis. And if you understand this, you understand why the wealthy never sell. Here's how it works. You buy a stock for $10,000. Over your lifetime, it grows to $500,000. You have $490,000 in unrealized gains. If you sell, you owe between 15 and 20% on those gains. That's $73,500 to $98,000 in taxes. So you don't sell. You hold. And when you pass away, your heirs inherit that stock. But they don't inherit your cost basis of $10,000. Under Internal Revenue Code Section 1014, they receive a stepped-up basis equal to the fair market value on the date of your death, $500,000. If they turn around and sell it the next day for $500,000, their gain is zero. They owe nothing. $490,000 in appreciation over your entire lifetime, completely erased from the tax records, never taxed, not by you, not by your heirs, not by anyone. This is why Warren Buffett has held Coca-Cola since 1988. This is why wealthy families never sell their real estate. This is why the phrase in investing circles is buy, borrow, die. You buy the asset, you borrow against it if you need cash so you never trigger a taxable event, and when you die, the step-up erases the gains. Your heirs inherit a tax-free asset, and the cycle starts over. And as of 2025, the estate tax exemption is $15 million per person, $30 million for a married couple. That means you can pass $30 million to your children without paying federal estate tax. And with the stepped-up basis, they owe zero capital gains tax on all the appreciation, too. It's a double shield, and it's completely legal. Here's the part that changes everything. And it's not about the tax code. It's about your brain. Most people treat taxes as an unavoidable cost of investing. They see the bill, they pay it, they move on. They never stop to ask whether the bill could have been different. And that passive acceptance is what separates people who build real wealth from people who just earn income and give a chunk of it back every year. The wealthy don't think about taxes after the fact. They think about taxes before every single financial decision. Before they sell a stock, before they rebalance a portfolio, before they take a distribution from a retirement account, they ask one question: what's the most tax-efficient way to do this? That one question, asked consistently over decades, is worth hundreds of thousands of dollars. It's not a loophole, it's not a hack, it's just discipline applied to a system that rewards people who pay attention. Let me tie all of this together, because when you see how these pieces connect, your entire approach to investing changes. You've got 5 strategies. Each one is legal, documented, and available to every American investor. Hold for at least a year, and your rate drops from up to 37% to 15% or less. Harvest your losses every year to offset your gains and reduce your taxable income. Use the 0% bracket whenever your income dips below the threshold. Max out Roth IRAs and HSAs so your gains are never taxed at all. And for the assets you plan to hold for a lifetime, the stepped-up basis erases the gains entirely when you pass them to your heirs. Stack these together over a 30-year investing career, and we're not talking about saving a few $100s. We're talking about the difference between retiring with $1.5 million and retiring with $2.2 million. Same salary, same contributions, same market returns. The only difference is whether you managed your taxes or ignored them. Your future self, the one looking back on your investing career 20 or 30 years from now, is either going to thank you for learning these 5 strategies today and applying them to every financial decision going forward, or wonder why you kept paying taxes you didn't have to pay when the information was sitting right here. The tax code doesn't reward the highest earners. It rewards the most informed. And now you're informed. The question is whether you're going to use it. So here's what I want from you. Which of these 5 strategies are you going to implement first? Are you already using tax loss harvesting? Are you maxing out your Roth? Or did the 0% bracket just blow your mind? Drop it in the comments. I read every single one. And if there's a tax topic you want me to go deeper on, Roth conversions, real estate depreciation, the wash sale rule in detail, tell me below. That's what this channel is for. I'll see you in the next one.